Good evening, folks. We are one day here before the FOMC meeting where the rate decision will be coming up. So let's do a quick pre-FOMC breakdown before the actual day itself. So the rate decision will happen on 4th of May, but it will be 2 a.m. in the morning. So most likely, if you are going to watch the FOMC press conference live, you'll be staying over Wednesday night. So as per usual, for Nimbus Capital Patreon subscriber, we will have a live session during this period. If there are any possible trade that we can take, later we will share, we will be taking those trades. Currently, right now, the consensus for the rate hike is 25 basis point. I do not think that they will be going for 50 basis point. That is obviously out of the question. 25 basis point is most likely, but we do have 17.1% probability of a no rate hike. Personally, my opinion is that 25 basis point hike is pretty much certain. And I do believe the market have already priced in the 25 basis point also. So the key thing about this rate hike is not the actual number itself. It is not a matter of no rate hike or 25 basis point hike. Market pretty much know the result of that probability already, but rather the forward messages. What does the FOMC plan going forward? So it is important to listen to the FOMC press conference and try to gather all these forward-looking statements. So before we go through what we kind of expect during the FOMC conference, let's take a look at a few data that we already have. Because previously, the last FOMC was in March. So we actually have the entire April without any news from the Federal Reserve Committee, without any news from Jerome Powell. But in between, we do have a lot of events that occurs. Firstly, just before the March meeting, we have Silicon Valley Bank blowing up, and then the Federal Reserve have to come into the rescue along with the Treasury. And right now, just a few days before the May hike, we have First Republic Bank blowing up. So obviously, we are going to be hearing some comment about the First Republic Bank. And in fact, JP Morgan bought out the bank, but from what I hear, JP Morgan didn't really pay anything. JP Morgan was actually paid to take up the liabilities of First Republic Bank, but the whole detail about that, you can probably find it online. That is not the topic for this. But anyway, we will expect a lot of questions from the First Republic Bank blowing up and the general state of the US banking system itself. So that is something that we want to pay attention to. But aside from the First Republic Bank issue, we do have a lot of data that came in during that period, mainly the inflation data. So looking at the inflation data, right, we have the US CPI already back down to 5%. And 5% is way back to 2021, July, August, that level like that. And currently right now, we have the CPI, which is at the same rate at the federal fund rate itself. Federal fund rate currently now at 5%, and the CPI is also at 5%. Generally speaking, if we want to bring inflation down, the general consensus is to raise the federal fund rate equal to the CPI level. Only then the CPI will come down. And in fact, this is what we are seeing here. So this kind of gives us a clue that perhaps FOMC is actually winning the battle against inflation. So recall back in 1970s where Paul Volcker actually have to raise the federal fund rate all the way to 20% because back then inflation was actually at 20%. But one thing that is a little bit worrying here is that if we look at the US core CPI, when we talk about core does not include volatile elements such as gas prices and food prices, because gas and food prices tend to be a little swingy, a little volatile. So in order to look at the more stable, in order to see the stickiness of the inflation itself, right, we tend to look at the core CPI, which the main components are things like health insurance, your shelter, your housing rent, all these kind of stuff, things that you actually have to pay quite a lot of money for. And in fact, something that is a little worrying is the core CPI actually went up during the latest reading, even though the CPI itself was drastically reduced. This kind of tells us that the reduction in CPI for March, it was actually due to food and gas prices coming down. However, the core mostly contributed by the shelter, it is still on the rise. So this is something we want to take note of. And next, we also have the PCE data, which came out not long ago. PCE is also a measurement of inflation data, but it is the preferred measurement that Federal Reserve likes to look at. So it is good that we pay attention to the PCE data also. So looking at this data, right, we also see similar action to the CPI data. We saw PCE data all the way down to 4% right now, slightly above 4%, which is around 2021 July level like that. But unlike the CPI data, the core PCE data is also down compared to the previous month. So in a way, this is slightly more of a good news compared to the CPI data, but we shall see what Federal Reserve have to comment about this. So it is important to look at what Federal Reserve projected during the last round of FOMC meeting also. So firstly, right, the PCE projection, the PCE that Federal Reserve projected for the end of 2023 is actually 3.3, and the core PCE is 3.6. So we are actually very, very near this number already. Probably maybe another 2 or 3 more months, we may see PCE going down all the way to 3.3, as long as there is nothing sticky that is present in the current US inflation. And the more important one is the federal fund rate. So in March, federal fund rate projected to be 5.1%, and this is as good as saying there will be no rate cut this year. In fact, during the March press conference itself, Jerome Powell explicitly stated that there will be no rate cut this year. But of course, maybe due to all the recent events that transpire, he may or may not change his tune in the May press conference. And lastly, we also want to look at what they are doing with the, what do you call that? I forgot the term already. Quantitative tightening. Okay, well, we want to see what is their plan on the quantitative tightening process. So in the last meeting, they mentioned that they have no plan to change the quantitative tightening. They will continue to reduce their holding of treasury and the mortgage-backed security. They will continue to unload. Okay, so there were some noises that is coming out from the retailer sphere where the Federal Reserve backstop, they came into the rescue for Silicon Valley Bank, and we saw that big spike in the Federal Reserve balance sheet, and so many retailers misanalyzed that as QE is back on. There is no more QT ready. QE is back on the paper, and that is one of the most, I would say, the funniest thing that I seen online, because that kind of comment shows that not really a lot of people know how to interpret the balance sheet. But in fact, during that FOMC meeting itself, this statement was being put up, and it is saying that Federal Reserve will continue to reduce the treasury holding. So whether or not the market is rallying or going down, it has nothing to do with the Federal Reserve balance sheet, but rather there are a lot of other forces at play. But the reason why we want to look at this is that Federal Reserve doing the quantitative tightening, it does impact the overall M2 supply. However, the rescue that they did for the Silicon Valley Bank did not affect the M2 supply. So when the QT is continuing to affect the M2 supply, right, it does have negative impact on the equity market itself, whereas the rescue mission for the Silicon Valley Bank doesn't really affect the equity market. That is my opinion on this matter, but nonetheless, right, we do want to look out for this statement in the upcoming May meeting also, whether or not are they going to slow down the selling, are they going to retain this rate of selling. I do think that they will continue to retain this rate of selling, but the moment they start slowing down their unloading, right, we may see a rally in the stock market, because now the rate of the QT is slowing down and we may start to see liquidity back in the market itself. So just to show you, this is the M2 supply data. I have gathered all the latest data, and you can see that the rate of the M2 supply contracting is getting faster and faster. So we can see that the QT is still in effect. That there is no QE going on. There's no QE going on at the moment. We are on a full throttle for QT right now. Okay, so based on all this, right, I sort of come up with what could be considered dovish, what could be considered hawkish. So if Jerome Powell state any possibility of a rate cut in 2023, most likely that will be a dovish statement. And if he say deflation like 20 times, I will think that the market may view that as a bullish signal also. But I mean, I wouldn't fault him, because we are really seeing deflation in the past few months lah. And of course, he do need to reassure the public of the stability of the bank itself, because if we look back at March, one day before the March meeting, Silicon Valley Bank blew up, and right now, a few days before the May meeting, the First Republic Bank blew up. So he probably need to reassure the stability of the banks lah. And also, we have the whole debt ceiling issue coming up again. US is going to be in default by 1st of June, if I'm not wrong. That's the latest thing that I've heard. So he probably need to reassure the market also. It is something that he did previously. He did say that regardless of what's going on, they must raise the debt ceiling. And of course, he will probably say something about the soft landing. So if you start to see all these comments being made, right, it is definitely dovish, very, very dovish. You may see the stock market start to rally. And on the hawkish side, these are the statements that you will expect. Firstly, he will reiterate no rate cut for 2023, but there will be pausing of the rate hike. But even then, right, he may not want to commit to the pausing. He will probably say something like, FOMC may reconsider hiking again if inflation recover, if inflation goes back up. The committee will definitely re-hike again. They are data dependent. They will look at month by month, all this kind of stuff lah. Okay, so that will definitely be a hawkish statement. And of course, we also hope that he can comment a bit on the core CPI going up, where the CPI is coming down. So there is some stickiness in the inflation. So he may be able to point out certain data that are causing this stickiness, and whether he think that is an issue or that is something that we can push through, it is something that will solve by itself. We do want to hear a bit of those. And let's say if the stickiness is quite serious, right, then of course it will be considered a hawkish statement lah. And also, I don't think Jerome Powell will purposely spread fart on the within the press conference. But I would say that the lack of reassurance, right, is definitely something that you want to watch out for. So if Jerome Powell is not really stating anything, not reassuring the current risk of the banking system, right, then you can consider as no news is bad news lah. Because normally in this kind of situation, right, you do want to reassure the public. And if you are not reassuring the public, right, then there may be something going on there lah. Okay, so these are the two extremes that you can look out for, but definitely there'll be something that can happen in the middle also. He may say something that I have not mentioned, or he may flip prata here and there, say something very dovish, and then cover that by saying something hawkish. We can expect all sorts of stuff lah. Okay, so if you want to come to our live streaming for the FOMC press conference, right? Do sign up for our Patreon, because we do sit down and look at what he's saying, and we try to decode what he is trying to what we try to read between the lines. We essentially try to read between the lines lah. So currently the yield curve is as inverted as it is. So this is something that we want to highlight. It does represent a lot of high risk, a lot of short-term high risk at the moment with all these recent stuff going on lah. Okay. Next, the government bond yield, the 2-year yield currently at the 4.12%, kind of ranging for quite some time. But let's say if we see the 2-year yield spiking above 4.261, then most likely we will see the 2-year yield going all the way back to 4.5%. And this is, I will consider it bad for the equity market. And if this movement were to happen, right, it is definitely due to a lot of the hawkish statement. Or regardless of what Jerome Powell is saying, the market will take it as a hawkish statement. So we do want to pay attention to the 2-year yield also. And of course, if 2-year yield were to go back up to 4.5%, we will definitely see the US dollar recovering, US dollar rallying. Currently, right now, US dollar is very close to the support at 100.9, and it is kind of setting up for a recovery. So we do want to pay attention to US dollar also. So one of the trade that we are looking at, which is using the FOMC as a catalyst, and of course, 1 day later, the NFP as a catalyst also, is to trade the US dollar. But more importantly, we are not trading US dollar itself, but we will be shorting gold. So currently right now, gold is at the resistance level. It is forming a triple top. If we look at the MACD and the RSI, it is showing that the upward momentum is actually slowing down. So we will be monitoring gold price, and based on the press conference and whatever Jerome Powell is saying, if we see that downward momentum coming in, we will be looking to short gold. And our hope is that it can go somewhere back down to probably 1,850 or 1,800. Once again, do not take this as a trade signal, because we are not in the trade yet. We will decide on the day itself, depending on how the press conference goes and depending on how the price action itself. Okay, guys, so this is all I have for the pre-FOMC breakdown. Hopefully you have de-risked yourself. Make sure you are not holding a bunch of long position or a bunch of short position. The key thing is to be balanced in terms of your portfolio. Make sure you are not overly exposed to the one side. We are living in a time of extremely high volatile moment. Okay, guys, all the best to you. Have a nice day. If you like our content, do subscribe to our channel and give us a like. It will truly help us a lot.